Hey Bulls and Bears, how we doing? Ford Motor Company just came out with some bad news. For those people waiting for car prices to crash, this is not good news. Ford warns that it has some bad news for car buyers and the economy. Ford is warning of more delays in production of vehicles, and you're going to see similar cases across the car manufacturing industry, unfortunately. And this is a report here out of thestreet.com. The news feels like a cold shower for many customers who have been waiting many months and then they receive this news. For those that have just placed orders for new vehicles, the news also renders delivery schedules for their cars uncertain. Ford has just said that the supply chain problems hobbling many companies, but particularly vehicle manufacturers, is far from being resolved. And they're pointing to the usual causes: the war, the rising cost of energy and transportation, and still we're seeing manufacturing countries with problems with the health crisis, right? So some of the things that are resolved here in the U.S. are still problematic in other parts of the world, especially these countries that manufacture so many of our products, and in some cases it's parts to manufacture products that are made here in the U.S. Even U.S. companies can't get parts because they have to be imported. So when something is made in the USA, when you see that tag that says made in the USA, it doesn't mean that it's 100% made in the USA. It may be the finished assembly may be manufactured here in the US, but 90% of the time, from what I see, about 90% of the time, the components and these products and goods are made overseas. Now, just a few reports ago, we talked about how car prices have came down slightly, and this was the wholesale price, or what dealers will pay at an auction, or if you go to an auction yourself, which consumers can do, they can go to auctions also. The prices came down close to 5%, and it's pretty interesting because we also see this number in the nationwide median home price. We see the prices now down about 5% after the most previous month's drop of about 3%. Now what's interesting is when the prices go down, the percentage decrease doesn't have to be as much as the price increased in order for prices to get back where they were. And I know that sounds strange. Let me explain it. So let's say a home price goes from $200,000 to $400,000. That is a doubling of the price. Simple, right? And that is a 100% increase from $200,000 to $400,000. So the price increased by 100% because it was $200,000. Now it's another $200,000, making it $400,000, right? So a 100% increase. So now the price is at $400,000. To get back down to $200,000 from $400,000, you only need a 50% price decline, right? So a 100% price increase, you only need a 50% decrease or drop in order to get back where you were. So from 200 to 400, 100% increase. From 400 back to 200, that's a 50% drop. See what I'm saying? So the price declines that we're looking at here, you may see, oh, it's only 3%, it's only 5%. Remember, this is more significant on the way down than it is on the way up because of the math that I just laid out. High prices, high cost of living is still driving people further into debt. A report here out of KTLA: rising interest rates, inflation leading consumers to rack up credit card debt. Nothing new, but the speed of this debt increase is increasing. And you have to ask yourself, are credit card companies, are these banks going to keep on raising the credit limits, or are they going to see people getting further into debt, and at some point they're going to start dropping these limits? So debt increasing, credit card ceiling dropping. Actually, I just had one of my credit card companies, Capital One, drop my credit limit because I didn't use the card enough, or because I paid it off in full. I had like a $14,000 credit limit. The most I would have on it from month to month is like anywhere from like $500 to $1,000, maybe $1,200. But luckily, I was able to pay it off in full every month. Because I'm paying it off in full, what they did is they looked at it as I have too much of a credit limit for my spending. So to protect themselves in case I was to get into debt or start increasing debt and not paying it off, I think they cut the line of credit. They definitely cut the line of credit, but I think the reason is because they see all the debt levels out there now. People are going to be more likely to put expenses like groceries and utilities on their credit card, and I think these card companies know now that a bankruptcy tsunami is headed our way, and I think some of these banks credit card companies might be lowering the credit limits because of that. Please let me know what you think down in the comments. Have you seen your credit card limit get decreased? Some pretty awful numbers, some pretty scary numbers out of this same article out of KTLA. According to Lending Tree, the typical consumer, the average credit card debt is $6,500. $6,500 with the credit card debt. Wow. And there's a story here, somebody named Cody Rice Velasquez, and they are now paying $1,000 a month just in interest. $1,000 a month just in interest. So we have people out there, and I'm sure there's millions of more like them, as described in this article, $1,000 a month. There's people paying interest on credit cards that are equivalent to a mortgage payment. And a mortgage payment would be even less in some parts of the country, less than $1,000 a month. How many people are out there? How many millions of people are in the same boat? How long can you keep going paying $1,000 a month just in interest? Are you even going to pay down the principal paying that type of interest? For the most part, not. Most of these people are headed right towards the bankruptcy tsunami that we feel is coming before the end of the year. We'll have to see how it plays out. There could be more rescue programs. The powers that be could mandate that the credit card companies put a freeze on the interest payments in order to keep this whole thing propped up, in order to keep this tsunami from happening. Will they do it? I don't know. But without some sort of a program like that, without some sort of intervention or rescue program, there's no other way around it. We're going to see a bankruptcy tsunami. Another interesting piece of news that came out. Goldman Sachs is now saying that the Fed is going to be unlikely to cut interest rates until 2024. Until 2024. I don't think the Fed should cut interest rates ever again. I think they should keep interest rates high. Why are we even talking about cutting interest rates? 2024 is way too soon, and any point is way too soon in my opinion. Please let me know what you think down in the comments. Why do we need to cut interest rates? Right? When debt levels are at this amount, you're just going to encourage more borrowing and more spending. Interest rates need to go up even higher and faster in order to stop some of these economic bubbles from getting bigger. The housing market, the car prices, anything that you could swipe a card for or borrow money to buy, this is going to help keep prices down. Higher interest rates help keep prices down. Is it going to be the solution? No, because we have a problem in the United States. We don't manufacture enough. We don't grow enough food here. We still grow a lot of food, but it's still not enough to keep up with demand. And that's why you haven't seen prices fall very much, even though they're raising rates. And even if they raise rates another 2% on the Fed funds rate, it's not going to grow more food. It's not going to manufacture more vehicles. It'll stop some of the demand because less people will be able to afford to buy these things, but it's not going to fix the problem. So I think 2024 is way too soon. And again, I think it should be a higher interest rate forever going forward. Of course, that's not going to happen. As soon as everything hits the fan, as soon as the bankruptcy tsunami hits, it's going to be cut rates, more QE, and more lending, and debt forgiveness, debt erasing of the debt, you name it, is going to happen. Another article out of the street. Elon Musk is out there again warning on the economy. Do we need any more warnings at this point besides what we can already see, what we know is happening? A major Fed rate hike risks deflation. Now, risks deflation actually would be good because it would make things more affordable. The problem is when deflation hits, also a lot of jobs go with it, right? We're already seeing it in the housing market. We see realtors having more trouble getting rid of homes, and we know that the number of realtors exploded over the past few years. You're going to have a lot of realtors looking for a different line of work. The same thing with these car dealers and car salespeople. They're going to have to look for a new line of work. So deflation is good. Things become more affordable, but then job losses will mount when this deflation picks up in these different areas and different parts of the economy. Now, Fed Chairman Jerome Powell came out again today and scared the markets, talking about ongoing rate hikes. And I'm not sure why the market didn't already have this priced in, because they've already been saying this now for many months. The Dow Jones actually today, Wednesday, September 21st, Dow Jones down over 500 points, about a 1.8 drop in the NASDAQ, the Russell 2000 down 1.4%, S&P 500 down 1.71%. Folks, we're not going to see a bottom until the talks of higher rates and future rate hikes is done. Right? This is all mouth. This is all mouthing the markets down, and it's sad that the markets have to rely on some guy, talking. It's pretty sad. We can no longer invest based on the strength of the company, based on earnings, PE ratios. All that means nothing. It's all about the money creators behind the scenes, and that's our economy, folks. Debt, money printing, QE to infinity, borrowing, spending, and pretending everything is good. Well, now the reverse is happening with the tightening and the higher rates. So prepare for more interesting scenarios to play out. We still have the supply chain issues to look at as far as the deflation versus inflation numbers. And hold on to your wallets, folks, because it's going to get wild and even crazier as we get later into the year. Hope everybody liked this update. Thanks for being here, and thank you for your support. Also, big thanks to Maria for your kind super thanks support. Thank you very much. You've given me many different tips and helped out this channel tremendously. Thank you very much, Maria. Again, thanks everybody for being here. Keep stacking. Be well. Bye for now. Peace.